Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. Election 24 with Nimesh, Shah and Roger Holman.
Welcome to The Tax Factor, the top 20 business and investment podcast, which brings you all the latest news and updates in the world of tax and provides analysis of what it might mean for you and your business. I'm Nimesh Shah, CEO of Blick Rothenberg.
And I'm Roger Holman, private client partner.
And as part of our commitment to covering the general election, not to be outdone, we are recording this episode of The Tax Factor from our very own Blick Rothenberg battle bus. I've been reliably informed it's even got a fridge. So, Roger, when we recorded episode 41, I somehow predicted a summer general election was about to be called. It wasn't clever editing. I did make that prediction, one of very few that I get right. And the Prime Minister, Rishi Sunak, didn't disappoint me, and he definitely didn't disappoint Heather and Robert last week, who had a bumper general election special of The Tax Factor. Following last week's bonanza, you might think we haven't got anything to talk about, but tax continues to dominate the general election, and it was the opening subject of the first televised debate between Rishi Sunak and Keir Starmer. But I'm not going to go straight into the general election. Just let's start off with a tax factor, business as usual, and our pet project, child benefit, and specifically a successful taxpayer appeal against a late payment penalty. Roger, what happened on this quite unusual case?
Thanks, Nimesh. And as you say, the penalties in this case relate to our favourite pet hate in the tax system, the high-income child benefit charge. Now, on first blush, this actually sounds like a slam dunk case for HMRC. The taxpayer pays the tax 232 days late, so is hit with two penalties, 5% for being 30 days late and a further 5% for being 6 months late. The total penalty was actually only £248. So all of that seems pretty straightforward. Tax was paid late, therefore penalties are due. As always with tax, that's never the whole story. Without going into the precise details of the case, HMRC sent a letter to Gareth Besant, the taxpayer, to pay the child benefit charge, stating he had 3 months from the date of the letter. Gareth paid the charge within 3 months, so didn't think he was late. Problem was that HMRC didn't actually issue the letter until June 2023, by which point the tax for the relevant year was already late, and HMRC didn't actually tell him in that letter that the penalties had already been applied because of the lack of payment. It was decided by the judge that the letter from HMRC was sufficiently misleading that the penalties were reduced to nil. Gareth actually represented himself in this case and clearly did a really good job of convincing the tribunal that he had a legitimate expectation that he'd paid the charge in time. From my perspective, this case really shows how the child benefit charge can cause huge complexities in normal situations. Not least because Gareth actually had a salary under the 50,000 threshold. It was actually his workplace benefits that tipped him over and created this charge. I'm not sure how many of our politicians would have been aware of this.
So lots of interesting things going on, and I'm not sure how many more child benefit cases we're going to cover on the tax factor, Roger, because the rules have changed. The threshold has gone up and the rate at which child benefit tapers slowed down. That was a Jeremy Hunt promise in the spring budget. But this case, HMRC just got it wrong in their paperwork, didn't they, really? They issued the wrong template letter and no one really took to check that. It does make me think, over a £248 penalty, why HMRC even took this case to the tribunal in the first place, because their letter was, as I said, fundamentally wrong. But nevertheless, they pursued it. And as you said, fair play to Gareth in this case, that he did pursue it, and he pursued it with some precision as well. Let's turn our attention away from child benefit to a current topical favourite, which is the general election. As I said, I didn't think necessarily we'd have too much to cover in the week that's gone by since Heather and Robert covered it so well last week, but it really hasn't disappointed. Week 2 of the general election when it comes to tax. At the time of recording, I haven't seen any manifestos. I've been quite busy today. I don't think they've landed yet, but they should be any point now. But we do know quite a lot about what the main parties, Conservatives and Labour, are thinking, or should I say actually what they're not thinking about, because there's a somewhat unusual situation right now, Roger, where both of the main political parties have said they're not going to raise taxes, really, but they're not going to reduce them either. We've got a bit round the edges, which I suppose we'll come on to talk about. And during that first television debate, Rishi Sunak referenced his triple lock plus, and Keir Starmer talked about that on private school fees and changes to the non-doms and increasing the rate for carried interest. We've been here before. We've heard about this, not only just in the last couple of weeks, but actually from the Labour standpoint, maybe over the last couple of years. Nothing that we didn't already know. But there have been plenty of rumours circulating in various quarters, and the press are going into overdrive about what might end up in manifestos, or in my view, actually, what's going to end up more in that first budget post-election. So, Roger, we talked about inheritance tax this week, and it's been making the headlines. So on the one side, the Conservatives saying, we're going to abolish it, we've been there before, or significantly cutting the 40% rate. But on the other hand, there's a general threat that the reliefs and exemptions in our inheritance tax legislation could be targeted, abolished, and trying to increase the take from inheritance tax. So what's been said, and if Mr. Sunak and Mr. Starmer are listening to your wise words, what would you be suggesting to them?
It's lovely to think that they might be listening to this. IHT is actually one of my favourite topics.
So they should definitely be listening, Roger. It's your favourite subject.
Definitely. It's something I've got some probably alternative views for a tax advisor. But if we ignore some of those views for the moment and get back to what's been going on in the press, it does seem like some of the journalists have finally picked up on that IFS report that we spoke about before, looking at IHT reliefs. And in particular, looking at business property relief. Now, business reliefs like this are supposedly there to encourage entrepreneurialism in the UK. Whether they actually work or not is probably a subject for another day. But the idea is that if you create a business and take all the associated risks and create jobs for the UK, you get a really benefit tax relief that means you pay no IHT on the value of your business. Now, the IFS study has a few radical suggestions, one being to limit the relief to an allowance of only 500,000. While I understand that sentiment, I think it's a bit of a blunt way of looking at this. Another option highlighted, and one that actually you spoke to the FT about recently, is that idea of restricting the relief to real businesses and not allowing it on just normal investments. In particular, we're looking at the alternative investment market, or AIM. This is a market of small companies listed on a tradable exchange, so a bit like the normal FTSE 100, but for much, much smaller companies. Now, shares in most of these companies will qualify for the relief, meaning people who invest in these companies can get 100% relief on those investments. My problem with so much of the reporting in the press is actually the use of the word loopholes when describing this sort of relief. If we continue down this line, we'll end up describing ISAs and pensions as tax loopholes. I long for the days when we can have a serious debate about the UK tax system as a whole, and perhaps even a full reform. But that's going to take a really brave politician and probably a project that would last more than a single parliamentary term. And I think we'd need cross-party support for that. Now, it's probably best I jump down off my soapbox and let you get on with the rest of the podcast.
I can understand maybe some of the policy desire to curtail the relief, the business relief on AIM shares. But God, this needs to be done really carefully, because my worry would be if there is a cliff edge abolition of relief on AIM stocks, what does that mean for the market? Could that potentially crash the market? And what does it mean for all the people that have saved into AIM shares? And we need to think about the demographic of people that have saved into AIM shares, which can be people who are the latter years of their life as well, who potentially need those savings as well. These are high-risk investments, so I do worry about policy changes which adversely affect what the market positioning might be in an already volatile market. But on inheritance tax, it has been talked about abolishing it completely. The Conservatives have talked about it's a very anti-conservative tax, but it does raise a decent amount of money. The OBR said that it's going to raise about $8.5 billion come 2028. Successive governments, including this Conservative government, have said they think it should be raising more. So it's unsurprising for me that reliefs and exemptions are under the spotlight, because you can plan around inheritance tax with some long-term thought around it and consideration, obviously getting some good advice from the likes of you, Roger. But the present government's secret weapon around tax policy could be to promise to abolish inheritance tax completely, Britain's so-called most hated tax. My question to you, Roger, and one for Mr. Sunak and Mr. Starmer, because they are listening, how realistic is that promise? Do you think it ends up in Conservative manifesto more so than a Labour one?
Certainly, I think if it's going to end up in either manifesto, it fits the Conservative ideals much more so than a Labour one. At the moment, if you have a joint estate of under £1 million, you don't pay any IHT at all. The vast majority of estates in the UK pay absolutely no inheritance tax. Now, that said, it could be actually actually quite simple to abolish IHT. But of course, there is a quid pro quo to that actually with IHT, you get a capital gains tax uplift on death. So you're treated as if you bought the assets on the death of your parent, say. If there's no IHT, surely there will be no CGT uplift. Or the alternative would be that maybe there is CGT on death. There simply has to be some kind of alternative if we're maintaining that we're keeping capital gains tax. Another suggestion being made by our good friend David Davis of Brexit fame is the idea of increasing the allowance to 5 million. I'm not sure I've done any cost-benefit analysis of this, but to be honest, I think it's probably going to be weighed too far into the cost column. So I would say that proposal, it's too complicated and it's unlikely to see the light of day. As an alternative, and it's something that I personally prefer, is the idea of reducing the rate of IHT to maybe 10 or 20%. In many European countries, and examples are Denmark and the Netherlands, where tax is actually seen to be quite high, IHT is actually 20% or lower. And in most of these places, they actually raise as much per capita on IHT as the UK does. So this is sort of demonstrating a theory known as the Laffer curve, where increasing tax rates often doesn't actually increase the tax take by a government. A lower rate of tax generally leads to less avoidance being considered and less need for people like me, as people don't mind paying that little bit more, but they really dislike paying tax when they see it's too much. It's a little bit like my point above, asking for a wholesale review of the tax system. Pretty sure that anything to do with IHT is going to end up in the too hard tray, and one of the many things in a manifesto that never sees a statute book. That's obviously if it does actually come into any of the manifestos.
So what I'm hearing, Roger, is definitely Roger Holman for Chancellor. Some great thoughts there. And I particularly like the David Davis idea, actually. Lots of estates are getting dragged into inheritance taxes, especially those that are sat on large amounts of real estate, in particular the family home. And if I think about our friends across the pond in the US, where they have a lifetime gift and estate allowance of, I think, around $13 million, you can see the simplicity of that regime. And one of the points that I've come across in some of the think tanks that have suggested reform of inheritance taxes is that the 40% rate as a headline is very high optically. As you say, Roger, this Laffer curve effect, that if you were to have a lower rate, would actually people plan less around it? Not good for seasoned advisors like you, but in terms of simplicity and thinking about your inheritance tax exposure as a family overall, I can see a real strong case for a reduced rate of inheritance tax, so it doesn't seem as scary, and a much higher lifetime or on-death allowance doesn't catch so many estates. It's a viciously complicated tax, and one that I would certainly encourage the government to think very carefully about. But as you said, I think I'm in your camp that unfortunately it's going to be in the too difficult column, and what I wouldn't do for a tax reforming chancellor if you are up for the job, Roger. But let's think then about another potential revenue raiser, which always comes up around an election time, and that is pensions. And we know that the government needs to raise some money, whether it's a Conservative one or a Labour one. The national debt as a percentage of GDP is in its 90s. It was over 100. It has come down a bit, and both parties are committed to getting that proportion down. And where are they going to raise the money from if they're not going to raise income tax, national insurance or VAT? And then I turn my attention to pensions, and I think they will come under the spotlight. Now, Labour have said that they would like to reinstate the pension lifetime allowance. We've had a previous tax factor episode on that, so maybe we'll park that for now. It would be really, really complicated, would be my view, if they are going to do that. And some are speculating, I've seen some of this, I don't know how true this is, that a Labour government might look to limit higher rate relief on pension contributions, which again do cost the Treasury quite a lot of money. Roger, I know you like a flutter every now and then. Where are you putting your pension chips for this general election?
I probably wouldn't look at reintroducing the lifetime allowance. As you said, it's unbelievably complicated and it's a bit of an absurd oddity in the tax system. The idea behind pensions is that we're encouraging people to save for their retirement so that we don't have to pay for them while they're retired. On top of that, we've got an annual allowance which restricts the amount that you can actually put into your pension in the first place. So having a lifetime limit kind of doesn't make any sense, because instead of talking about lifetime limit on the amount you can put in, it's really a lifetime limit on the amount it can grow. And that doesn't seem like the right sort of thing to do. with long-term investments. I think a better option is the idea of doing something around IHT on pensions. And this is probably where I land into that alternative view camp again. It just doesn't make much sense that assets held in a pension are completely free from IHT if the idea of saving for a pension is to provide an income in retirement. Now, if we had IHT on pensions and combine that with an idea of limiting or abolishing higher rate relief on pension contributions, that could actually generate billions to fill that black hole that either party is going to face when they look at the public finances. I don't actually think either of those options will make that much of a difference to people's standard of living either.
Interesting thoughts there on pensions and how the upfront relief may interact with the inheritance tax exemption on death. We're not going to solve that conundrum on this week's episode of The Tax Factor, Roger, and we are almost out of time. So I do hope that Keir Starmer and Rishi Sunak have been listening. Otherwise, they're going to have to come up with their own tax ideas rather than steal yours, Rogers, in those final versions of the manifestos, which I expect we'll be talking about next week. But before we do finish up, a bit about general election maths, I suppose. And in the first live television debate, there was lots of talk from Rishi Sunak attacking Labour's fiscal black hole, 38 billion, and every household having an additional £2,000 to pay under a Labour government. Quite amusingly, the Treasury have come out over the last few days and said that that is not a number that should be attributed to Treasury costings. Now, I expect the damage has probably already been done from Rishi Sunak towards the Labour Party's position on taxes. But interesting for a public body to come out with such force to say that that's not our number. And I know that since then, Rishi Sunak has come out and doubled down on that number, saying that actually the number may be even slightly higher, close to £2,100. And I think the Conservatives also maybe should look a little bit closer to home on their own maths as well, because when looking at the triple lock plus promise, which the Conservatives said in their press release was going to be worth £275 per annum by the end of the next Parliament, well, sadly, this is what I do in my spare time, Roger, which is have a closer inspection at their maths. And I spotted a transposition error in one of their personal allowance figures. The correct saving actually should be £270. Now, £5 isn't going to break the bank. It's not the end of the world, but with 8 million pensioners estimated to benefit, that overstatement is £40 million of additional costings into that policy. And on that 40 million bombshell, that is all we have time for on today's Tax Factor. Roger and I have set ourselves a Tax Factor challenge to see who can buy the most marshmallows with that £5, obviously not forgetting the very unique tax treatment of said marshmallows.
The Tax Factor, Election 24.
My thanks to Roger for joining me on this week's episode of The Tax Factor, and congratulations again to Mr. Bezant for reading the HMRC small print.
You can keep track of our election coverage and insights on our website, Blick Rothenberg /election24. Next week, Robert Salter will be back with Ellie, having hopefully pored over the tax small print of the manifestos.
It's goodbye from me, Nimesh Shah. Thanks very much for listening and have a great weekend.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on The Tax Factor.